Topic introduces private credit as a rapidly growing segment of global financial markets that involves non-bank lending to corporations, middle-market firms, real estate projects, and other borrowers. Private credit is generally provided by asset managers, private debt funds, insurance companies, and institutional investors rather than traditional commercial banks. The growth of private credit accelerated after the global financial crisis because tighter banking regulations reduced the willingness and ability of banks to extend certain types of loans. Private credit transactions are typically customized, illiquid, and negotiated directly between lenders and borrowers. As a result, private credit offers investors potentially higher yields and greater flexibility compared to traditional fixed-income investments. The topic explains several defining characteristics of private credit investments. These loans are often privately negotiated, less standardized, and not actively traded in public markets, making them relatively illiquid compared to publicly traded bonds or syndicated loans. Borrowers are frequently middle-market companies or firms with specialized financing needs that may not have easy access to public capital markets. Private credit structures may include direct lending, mezzanine financing, distressed debt, real estate lending, venture debt, and specialty finance arrangements. Because lenders maintain closer relationships with borrowers, private credit investors often gain stronger covenant protections, customized repayment structures, and more direct oversight of borrower performance and operational developments throughout the life of the loan. The topic also highlights the appeal of private credit from an investor perspective. Private credit investments generally offer higher yields than traditional investment-grade fixed-income securities because investors are compensated for illiquidity, complexity, and elevated credit risk. Institutional investors such as pension funds, insurance companies, and endowments increasingly allocate capital to private credit in search of enhanced returns and portfolio diversification. The floating rate nature of many private credit loans may also provide protection during periods of rising interest rates because coupon payments adjust upward as benchmark rates increase. Additionally, private credit can offer lower short-term market volatility because valuations are not continuously marked to liquid public market prices, although underlying economic risks remain significant. Topic also focuses on the risks associated with private credit investing and emphasizes that the sector may contain substantial hidden vulnerabilities despite attractive returns. One major risk is illiquidity because private credit assets are not actively traded and may become difficult to sell during periods of market stress. Investors often commit capital for long investment horizons, limiting flexibility and increasing exposure to changing economic conditions. Credit risk is also significant because many borrowers operate with higher leverage, weaker credit profiles, or limited access to alternative financing sources. Economic downturns, rising interest rates, or declining cash flows can therefore increase default probabilities and reduce recovery values on private credit investments. The topic further explains that valuation and transparency risks are particularly important within private credit markets. Unlike publicly traded securities with observable market prices, private credit valuations often rely on models, estimates, and manager judgment. This creates the potential for valuation smoothing, delayed recognition of losses, and reduced transparency regarding underlying portfolio risks. Investors may underestimate true portfolio volatility because reported valuations adjust less frequently than public market prices. The topic also highlights operational and systemic concerns, including leverage usage, interconnectedness with broader financial markets, and the growing role of non-bank financial institutions. If economic conditions deteriorate significantly, private credit losses could contribute to broader financial instability and liquidity pressures across the financial system. The topic concludes by emphasizing the importance of risk management, due diligence, and regulatory oversight within the expanding private credit industry. Investors must carefully evaluate borrower quality, covenant protections, collateral structures, liquidity terms, and manager expertise before allocating capital to private credit strategies. Stress testing and scenario analysis are especially important because private credit portfolios may perform differently under adverse economic conditions than historical performance suggests. Regulators are also increasingly monitoring the sector because rapid growth, leverage, and interconnected exposures could create systemic vulnerabilities similar to those observed in previous financial crises. Ultimately, private credit offers attractive investment opportunities but also requires disciplined risk assessment and strong governance to manage the unique challenges associated with illiquid and less transparent lending markets.